Right. Well, hello and welcome to today's webinar, Weed Out the Week with VMQ Stocks, led by Charles Rotblut. Thank you for joining this afternoon. We are happy to have you all here. My name is Jennifer Shear, and I'll be your host for today. And I want to remind all of our viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And a handout of the presentation is available under the handout section of your GoToWebinar control panel, located on the right-hand side of the screen. And if you have any questions for our speaker during the broadcast, please submit them using the questions section of your GoToWebinar control panel. And any outstanding questions not addressed after the presentation can be emailed to members@aaii.com. And if you happen to experience any issues with the audio or video of the webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support at gotowebinar.com. And of course, a friendly reminder that this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts, as well as any resources we discuss. And for all of our new viewers, we'd like to give a little background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. So please sit back, relax, and enjoy the presentation. The floor is yours, Charles.
Thank you for having me, and I'm joined by John Bukowski. Hi, John.
Oh, it's a pleasure to be here, Charles. I'm really looking forward to your presentation. I mean, I'm not sure about you, but one of my big struggles is I come across stock ideas all the time, and I struggle with how I can go ahead and make a determination if the stock I'm looking at is attractive, or also, when you buy a stock, when is the time to sell it? And those are things I struggle with. I know that you're the editor of the AI Journal. You probably get those questions from members all the time. So I'm looking forward to what you have to say about those topics today.
Yeah, absolutely. We're absolutely going to discuss that today. And VMQ, just as a brief overview, is a quantitative system. I just want to point out that all of our model portfolios at AAII, to everybody listening, they are all quantitatively based. They're rules-based. We're evidence-based investors. We believe we're also rules-based. And I think just in general, before we get into the presentation, that if you have certain characteristics you want in stocks and you write those down and you consistently look for stocks with those traits, I think you'll find that it simplifies the investment process and allows you to be more focused and find stocks in general that more match the traits you personally desire.
Yeah, we kind of joke around the office. I think we kind of call you the professor. And I mean, no, and it's a good way too. I mean, obviously when you were researching your book, Better Good Than Lucky, you came out with a method for going ahead and putting a portfolio together, but you didn't stop there. And I really enjoyed working with you as you were developing the VMQ process because you kept looking for techniques that had a strong history of working well to separate out the winners from the losers, but in a way that could be combined and in a way that individual investors could follow as well. Because too often we see strategies that may be good theoretically, but are so impractical that the typical person on the street really cannot implement them. So I'm hoping you're going to give us a little bit of insight to that today.
Yes, I will. And John deserves a lot of credit too. John gave a lot of input as we were developing it. But yes, I did put a lot of research into it, and it's something I wanted to provide for members. But even for my own self, I wanted to know, okay, what characteristics work and what characteristics should we focus on, and that's some of the origins behind VMQ. But
so, with that in mind, Charles, I'm going to let you take it away. I'm going to fade into the background here. I'll be watching any kind of questions that come up, and I'll be giving, obviously we have a lot of people listening here today and paying attention, and I'm sure we'll be getting some good questions. We'll do our best to answer as many as we can, but please pop your questions in, and I'll try to stump Charles once or twice over the course of the next hour or so.
We have, just before I start, I will say we have joked about possibly having a stump the Chuck, type of a form at some point. So far I've resisted, but we'll see. But today I want to talk to you specifically about VMQ stocks. And the presentation is called Weeding Out the Weak with VMQ Stocks. And as I said before, this is a quantitative approach to investing, but it's also a very active approach. So when people hear the word active and investing, they often think it means trading in and out, constantly trading, day traders, maybe meme stocks, which really isn't what active investing is. An active approach is really one where you're trying to create a portfolio that is different than the index. So you're not trying to buy the markets, you're trying to get returns different than the market by actively selecting which stocks you will hold, versus a market index approach is a passive approach where you're buying primarily indexes that track the broad, well-known indexes. And if you want to just have returns like the markets, then you can buy index fund. But if your goal is to actually do better than the markets, then you should not have a portfolio that looks like the index. You should not have a portfolio that looks, say, like the S&P 500. There's nothing wrong with tracking the S&P 500. There's nothing wrong with being a Jack Bogle type investor. But if you're going to have a portfolio that looks like the S&P 500, I would strongly suggest you look at a fund that tracks the S&P 500. This is the Vanguard S&P 500 VOO. As you can see on the screen, its expense ratio is 0.03%. It gives you exposure to the index at extremely low cost. You don't have to do any work. So if you want the index returns, that's fine. Look at this, maybe look at a competitor ETF, maybe the S&P, the Spiders. BlackRock has an S&P 500 fund. Vanguard has a mutual fund version of this. But if you want returns that are going to be better than the markets, then I suggest you have a strategy that leads you to a portfolio that does not look like the S&P 500, because that's where you'll start to get your advantage from. And it's important to realize that you need to really be active. When we look at the universe of actively managed large cap funds, these are mutual funds run by active managers that often charge more, not often, always charge more than an S&P 500 index fund. Their job is to get you returns higher than the Vanguard S&P 500 funds. Because why else would you pay an active manager to get you returns that are like the S&P 500 unless they're going to do it for the same cost? But what we find when we look at active funds is that most large cap active funds are what we describe as closet index funds. About 90% of the returns can be explained by the performance of the S&P, by the performance of the S&P 500. So you end up paying more to get similar returns. That's not a really good bargain for most investors. Now, are there exceptions? Absolutely. But by far, most large cap actively managed funds, you're getting the returns of the S&P 500 largely, the similar volatility, but you're paying a lot more. Again, not a good strategy. And the thing is with a lot of active mutual fund managers is they're smart people. They know what's worked well over the long term, but they can't do it because they face what's known as career risk. They know what characteristics of stocks have been associated with good long-term returns, but not every characteristic, not every factor works over every period. And because of these factors associated with long-term returns can endure periods of underperformance, it creates strain on the fund managers where they're worried about underperforming their peers, and they're worried that if they underperform their peers, they'll lose their clients, and then they'll lose their jobs. And I want to point out that I've been at professional conferences where I've seen this discussion play out, where I've seen speakers talk about strategies associated with really good long-term returns, such as value. And I've seen fund managers in the audience saying, I agree with everything you're saying, but my clients will not let me do this if it means I'm going to have periods of underperformance. So the strategy I'm going to show you today, a lot of mutual fund managers can't do it. And that creates an advantage for you because the less people you have following a given strategy associated with good long-term returns, the more likely those good long-term returns, those prospects of beating the market is going to hold in the future. And as an individual investor, it's really important to realize you have two huge advantages. One is you never have to report your performance. Okay, if you're married, you might have to tell your spouse, but by and large, you never have to report your returns. What that means is you can look at strategies like value, like momentum, and you can take a long-term approach to following those. And if there's shorter periods where maybe they're out of favor, you have the ability to stick with the strategy because nobody's going to fire you. The other thing is you can invest in stocks of all sizes. You're not limited to large cap stocks. You're not limited to stocks, say in the Russell 1000 or Russell 3000. You can go up and down the market capitalization scale. What that means is you have access to the full universe of stocks. Most professional managers are limited in the type of stocks they can invest in terms of size. They might have restrictions on, say, limiting them to large cap stocks, or maybe they're a small cap manager. They still have limits in terms of what they can invest in because they have so much money to invest, but they also have to be concerned about their ability to get in and out of a stock without moving the share price. We investors are dealing with, relatively speaking, much smaller portfolios, and that gives us a lot more flexibility in terms of having a broader universe of stocks to invest in. So it's really important to realize that as an individual investor, if you're going to invest in stocks, realize you have these two big advantages. And as I said before, they're huge advantages, and use them to your own good. Use them to beat the market. And so we talk about keys to active investing. As I said before, we're not talking about getting in and out. We're talking about having a portfolio that doesn't look much like the S&P 500 or other broad market indexes. So if you're going to have this, what's going to lead you to success? Well, one of the things is just asking, has the approach historically worked well? Is it based on characteristics when we look at past market history, characteristics associated with longer term outperformance? Can you apply it in a systematic way? Do you have strict rules you can follow that guide your buy decisions and your sell decisions? And this applies no matter what type of active investing you're doing, whether it's fundamental based or whether you're using technical analysis or a combination. You want to be rules based and have clear rules governing your buy and sell rules. They will your buy and sell decisions. They will take the emotions out of those decisions. And finally, again, you do have to be willing to endure some short-term pain. Investing is a long-term gain. And you can have strategies that work really well over the long term, but over shorter periods, they might not do so well. And that risk of them lagging over shorter periods of time actually leads to higher long-term returns. So you're going to get rewarded, but over the short term, the road could be a bit bumpy. And so what kind of traits are associated with these long-term outperformance? Well, we tend to focus on factors. Factors are basically a trait associated with higher returns. In academic speak, they look at what's known as a capital asset pricing model, which in very simplistic terms says that a stock's expected return is basically the equity premium, the higher return you get over, say, treasury bonds, adjusted for the stock's volatility. When academics started looking into it, they started realizing that's not really right. We find these exceptions, these anomalies. Value stocks tend to outperform over the long term. Momentum stocks, quality, size, and their performance is great. Their performance advantage is greater than we can explain simply by the risk alone of investing in those stocks. Now, what stocks tend to have lower long-term performance relative to the risk? Growth, stocks with weak momentum, stocks are poor quality, or even stocks with large size. Over the long term, there's a small cap premium, meaning that if you go down in terms of market cap size, you're more likely to have higher returns. But I will add that small cap premium, we do see it skewed to the value side. So it really is small cap value where you see that advantage. Now, VMQ Stocks is an example of this active approach and how to use factors. The initials of VMQ actually stands for value, momentum, and quality. And I'm going to explain how we settled on these three things. And really the cornerstone of our strategy is value and momentum. Value, the reason why we chose value is that value beats growth. Cheaply valued stocks outperform highly valued stocks. And we see this across valuation multiples. This is data from Ken French, a Dartmouth professor. He provides data going back to 1950 or even back to 1920s, depending on the indicator. But as you can see here, whether we're looking at price to book, price to earnings, price to cash flow, if you buy stocks whose valuation ratios rank in the lowest 30%, and you avoid stocks whose valuation ratios rank in the top 30%, historically, you would have received outsized returns. And this data goes back to 1952 to 2021. So we're looking at approximately 70 years of data, and you can see over time how well value has performed relative to growth. And it goes across multiples. And that's important because when we look at different ratios and we see it, this factor continuing to hold up, that tells us the economic reason why this works, but also tells you that this factor is persistent. It's not a one-time occurrence that's a result of data mining. We do actually see this outperformance happening over time and across ratios. And I believe there's a simple reason why value beats growth. It's that because when a stock has a high valuation, it usually reflects high expectations. People hear about the company doing well, maybe it's growing, maybe it has a new product that people are gravitating to, but as the price continues to rise, so do the expectations. And at some point, the expectations get so high that the company cannot match those expectations and the stock price falls. A good example of this happening, we saw this with Netflix about 2 weeks ago, where the subscriber growth wasn't quite what investors expected. Meta Platforms, formerly named as Facebook, they recently dropped. And are those two recent examples? Absolutely, but we've seen this play time and time again over history, where there's a growth stock, company's doing well, but expectations get so high and expectations for future growth get so high that the company cannot possibly meet them. The company disappoints, stock price falls. You don't see this as much with value stocks because people don't build up their expectations as much. Can a value stock disappoint and fall in price? Absolutely. It's not immune. Value stocks are not immune from falling in reaction to a bad earnings reports, but we do see value stocks tending to pop more on positive earnings news because investors are caught off guard. They're anchoring this company as a company that perhaps doesn't have growth prospects, or perhaps a company that's struggling, or perhaps a company they're not expecting great earnings from. And when those companies report upside expectations, investors weren't expecting them, they readjust their expectations, and that pushes the stock price up, leading to some of that value premium. Now, when you use valuations, low valuations, there's two ways you can actually go about it. One is to use relative valuation, and this is what we use for VMQ, and we also use an A+ for A+ grades. And so what relative valuation is, is basically you take the whole universe of stocks and you rank them by valuation. So at the bottom, your 1 percentile, your 2 percentile, those are the cheapest stocks ranked in valuations. Your stocks with the lowest price to book ratios, your stocks with the lowest PE ratios. At the other end, at the top 98, 99 percentile, those are your most expensive stocks. Your stocks with the highest price to earnings ratios, your stocks with the highest price to cash flow ratios, your stocks with the highest price to sales ratios. So we're basically looking, how does this stock's valuation compare to all other stocks? Now, the big advantage about using relative valuations is that you always will find stocks. Because it's a ranking process, there will always be stocks, say, in the lowest 40%. The downside of relative valuations is that if the stock market itself gets really expensive and most stock valuations get really expensive, then the cheapest stocks will tend to have higher valuations on an absolute level as well. So maybe a price to book ratio of 1, say ranks in a 30th percentile in one low valuation environment, but a high valuation environment, maybe that 30 percentile is a price to book ratio, say 1.5, it adjusts. And so for investors who want absolute valuations, say a price to book no higher than 1, maybe you want a PE ratio no higher than 12, those ratios work really well for making sure on an absolute level you never overpay. The downside of those ratios, however, is that when the market gets more expensive, you're going to find fewer stocks passing your screen. You're going to find fewer stocks to buy from. Now, some investors might find to be an advantage as almost a timing indicator telling them the market's really expensive. Maybe I need to be less in stocks. And when a lot of stocks start qualifying, they might be assigned to them that, hey, the market's really cheap. I need to load up on stocks. And that is a strategy. It's not the strategy we use. We use relative valuations. And I will point out that even with our model shadow stock portfolio, where we do give absolute ranges for valuation ratios, those are based on relative rankings. Where is the bottom 10% for size? Where is the bottom 10% for value? So we're still using relative valuations, but we're giving people benchmarks as to where those relative rankings are actually exist for the shadow stock portfolio. For the VMQ portfolio, we just use the pure relative ranks. But the other thing with value is that some stocks are cheap for a reason. And when I get to quality, I'll show you how we avoid those stocks that are cheap. Because what we're looking for in VMQ is we're looking for bargain stocks. It's okay if a stock is dinged up, it has rust spots, as long as it's priced below what another investor might reasonably pay for it in the future. And we don't have to know exactly what an investor might reasonably pay for it in the future. We don't have to know what that price is. We just have to know that right now the stock's really cheap, and all the other criteria suggest to us that maybe it's too cheap and its price should rise. Now with value measures, I mentioned a few before, a few ratios. We combine 6 different valuation measures with VMQ. We look at the price to sales ratio, we look at price to earnings, enterprise value to EBITDA. For those of you unfamiliar with EBITDA, it's earnings before interest, taxes, depreciation, and amortization. We look at shareholder yield, which is basically looks at what percentage of the shares outstanding have decreased or increased over the past year. And we're looking for decreases specifically in shareholder yield because when share count decreases, that's associated with rising price. Even though I know there's some controversies with share buybacks, shareholder yield has been shown over time to lead to higher returns. We look at the price to book ratio, and finally, we look at the price to free cash flow ratio. And so the way we actually look at all of these and actually combine them to do a value score is a 2-step process. First of all, we look at each individual valuation ratio. For here, I'm showing it for Sally Beauty Supply, one of the companies we hold in the VMQ portfolio. Sally Beauty Supply, its price to sales ratio is 0.47. That ranks in an 11th percentile. So based on its price to sales ratio, Sally Beauty Supply ranks in the bottom 11% in terms of the cheapest stock. So of all the stocks, Sally Beauty Supply's price to sales ratio is the 11th% cheapest. So really cheap stock. And we repeat this process for every valuation ratio used in our value score and used in our value grade. And then we look how a stock ranks relatively across all those rankings and compare that to all other rankings. So we look at Sally, how does it compare across all these ratios or all the ratios it has valid scores to? And then we do the same exercise for all other stocks. We go through each of these ratios. Where does it rank on this one? Where does it rank at this one? To create a composite rank. And based on that composite rank, we then compare that stock's composite ranking relative to the composite ranking of all other stocks, and we create a value score. So a lot there. So what this basically tells you is that we look across all the valuation ratios used in our value score. Sally Beauty Supply has the 18th cheapest relative valuation, meaning of all the stocks in the universe, Of all the stocks we can create value, we can calculate valuation scores for, Sally Beauty Supply ranks 18th in terms, 18th percentile in terms of valuation. And again, lower numbers are cheaper. So we rate valuations from basically 1 cheapest up to 100, the most expensive. So this is telling you that Sally Beauty Supply ranks in the bottom 20%, or I should say the cheapest 20% of all stocks. So that implies it is a true value stock. So to calculate our value score, it must have a valid ratio for at least 2 of the 6 ratios. And the reason why we don't require valid ratios for all 6 indicators is we want to cast a wider net. So if we make this too restrictive, we'll get too few stocks. That limits the universe, and it might cause us to miss out on a particular company. Perhaps the company has had one quarter where they took a big write-down. It gives it a negative price-to-earnings ratio. Perhaps the company spent a lot of cash flow building up its inventory, so it has a negative price-to-cash flow ratio. If it has a negative ratio for one of those criteria, we don't want to kick the stock out. We want to be able to calculate it to give us a broader universe, that allow us to cast a wider net. So again, this is a 2-step process. We calculate the percentage rankings for all valid ratios, and then we do the average valuation rank. And so we're really trying to figure out how is this stock valued based on all these criteria, based on all other stocks measured the same exact way. Now, the thing about value, I talked about this before, about how you need to be a little bit patient when you're using factors, because we can't have things like what you see here, which is a value drought. And so this is really for the period of 2018 through 2021. And this shows you the performance of value over certain periods. Price to earnings, you can see lagged. Price to cash flow lagged. But if you look here at value, at price to book, you start to see price to the book starting to shift. Had I done this 2017 through 2020, you would have seen, or even just 2018 through 2020, you would have seen value actually underperforming. But we've seen this recent turn real quick. And I'm going to talk about this in tomorrow's investor update about relative valuations. If you look at where valuations are now between the cheapest stocks and the most expensive stocks, or we could say value stocks versus glamour stocks, the valuation spread, meaning the difference in valuations between the growth stocks, the highest valued stocks, and the lowest valued stocks, is at extreme levels. In fact, even though last year value outperformed growth, the investment firm AQR found out that this difference in valuations between the growth stocks and value stocks is at the 98th percentile, and that's pulled back. So meaning that growth stocks are still extraordinarily overvalued relative to value stocks. So if you're a value investor, you believe in value investing, and you've been frustrated because there's been this value drought, there is evidence, and we've seen it even on our end, we've looked at valuation ratios, that this pendulum could be swinging back. And in investing, there is this concept known as reversion to the mean, meaning that historically there's been a certain relationship, and the current relationship is different than that. So say currently we've seen valuation ratios between value and growth stocks be in this level, tight range, and also that range extends, then reversion to the mean says, well, it should come back to where it was historically. Now, the thing about reversion to the mean is it's known as a pain, because if it catches somebody off guard, it can actually send a wrecking ball through their portfolio. But if you're waiting for reversion to mean to occur, it can be painful as well. And so I don't want to tell you right now that this reversion to the mean with value has started and it's going to occur right now. But what I can tell you, when we look across the board, we are seeing signs that growth is way overvalued growth is too expensively valued relative to value stocks, and that historical data paints a really good picture for value to outperform. And again, history does not tell you what's going to happen in the future, but all we have to go off of is the historical odds. The historical odds have shown us time and time again that value investing works, and investors get rewarded for buying value stocks. And this fear of underperforming, this fear of value droughts, is one reason why the value premium exists. If there wasn't this fear of underperformance, and if there wasn't this short-term periods of value underperforming, then you wouldn't have the upside returns of investing in value. The premium for investing in stocks and the premium for going away from the S&P 500 is these higher long-term returns. The cost of deviating from the S&P 500 is a shorter-term risk of underperformance. But as an individual investor, because you don't have to report your performance to anybody, you have the ability to withstand these shorter-term periods of, say, the value droughts to get that long-term reward from being exposed to value and getting those much higher long-term returns that have historically existed. John, before I move on to momentum, are there any questions?
Yeah, a number of good questions have come up. In fact, you're talking about the drought period here. I just was looking at one of the top performing strategies last year was the O'Shaughnessy small cap growth and value. And looking back at his book at the time, he was talking about how stocks often run in 20-year cycles, these strategies. So really, you almost have to have a 20-year time horizon when you do pick a strategy and understand that you're going to have to undergo some of those ups and downs to really succeed long term. And perhaps looking back, that's always the dilemma of the investor is too often we chase last year's performance. And that's why often investors' rate of return is much lower than the actual fund rate of return because we're buying them at the high point and selling them at the low point when they're down. In terms of questions here, so if an investor holds 20 to 30 stocks and they're in the S&P 500, is that considered being a closet indexer?
You know, it does depend which stocks you're buying, but that's all your portfolio is, then you are going to get returns more similar to the S&P 500. Now, there are always going to be stocks with the S&P 500 that are going to perform better, going to perform worse, and I'll show a chart a little bit later showing the sub-indexes of the S&P 500, so you can see that if you tilt your portfolio, say to value or perhaps growth or perhaps high dividend growth, you'll get that outperformance. But the more stocks you hold within the S&P 500, the more your returns are going to be similar to it. Now,
The other
this doesn't
factor
mean
is
you should,
weight still, right, Charles? I mean, because
right,
I'm not
exactly.
sure you were getting into that perhaps, but
Yeah, right, sector weights. Now, one thing I will point out is that you can buy large cap stocks and not necessarily get the return that's S&P 500. I'll show you those subsets, but also even in VMQ, I hold stocks like Target. So the key is that if you're going to invest just in large cap stocks or hold large cap stocks, you want to make sure you're tilting in some form or fashion. As John mentioned, you could tilt towards tech. For instance, you want a lot of tech, or perhaps you like energy and you weight your portfolio that way, or perhaps you weight your portfolio towards some large cap factors. And I'll show you some of those that the S&P 500 tracks. So it's still possible, but if you're buying the broader the universe of large cap stocks you buy, the more you hold, the more your returns are going to be like the S&P 500. Now, if you hold 20 or 30 and you're really tilting towards either sectors or certain styles, then you could actually have returns that are going to be different than the S&P 500. You're still going to be affected by the overall performance of large cap stocks, but you could be active and still hold a large cap portfolio. But most mutual fund investors, we see them holding a lot more than just 20 or 30 stocks.
and maybe we're jumping ahead a little bit here, but I've got a question here from Robert. What do you think about the notion of creating a composite score, where basically you equally weight the V, the M, and the Q components, and sort those to have the best score, and then kind of look at the ones that have the higher value within that segment. Any thoughts about the composite type ranking like that?
Yeah, well, when I add stocks to the VMQ portfolio, that's essentially what I'm doing. So I actually take the stocks, and we have a downloadable spreadsheets on our VMQ site. So you can actually, if you wanted to sort the data, you absolutely could and do some sorting yourself on Excel. But I actually look for the stocks with the best combination of value and momentum. So cheapest value score, highest momentum, look for the best mix of that. And then I look at quality, and I really use quality more as a tiebreaker, but you certainly could combine all three. And we've had discussions internally about whether at some point we might consider having a composite score, and whether or not some subscribers to VMQ might find it useful to have that composite score. You absolutely could. And I will say real quick for factor investing, I think you'll find two camps. You'll find the purists. Jack Bogle talked about this a few months ago in the AAII Journal, where he really thinks people should have one subset portfolio completely allocated to value, another portfolio allocated to momentum and keep them separate. But you have other people, Cliff Ness at the investment firm HUR, who actually thinks you should combine them into a single portfolio. And you see some smart beta portfolios doing that as well. I haven't seen any studies saying that one's absolutely better than the worst, but one has an advantage. But we do know that when you combine value with momentum, you actually do get higher returns. And whether you have two portfolios or you combine them in a composite manner, I think at that point, it doesn't make a big difference. I think you need to be more concerned with just being disciplined in how you allocate the strategy than worrying that one might be incrementally better than the other.
Thank you. I've got some more good questions here. Please keep having them come in, and we'll save them till later on in the presentation. Thank you, Charles. Continue. I'm
Sure,
looking
thanks,
forward
John.
to your momentum portion. I think it's coming up next.
It is. I'm not actually give me the lead in. So we're going to talk about momentum. So momentum is basically how a stock's price has performed relative to all other stocks. So momentum is really a relative strength type factor. It's favoring stocks that have outperformed, and it's punishing stocks that have underperformed. And the reason why momentum works is very simple. Investors like winners. Who doesn't want to own a stock that's rising in price? Now, obviously, you're trying to buy it. You don't want it to rise too far, but once you own it, as Ralph Cranham used to say, to the moon. But we see that over time, momentum works really well. We see this in both small company stocks and large company stocks. So again, this data is from Kenneth French's library. And he actually splits it up among small company and large company stocks. But if we look at the stocks with the strongest momentum, meaning the stocks with the highest 30% of return, whose returns rank in the top 30%. So the top 30% performers, take all the stocks in the universe, which stocks had the highest 30% performance. I believe French is looking at the last 52 weeks in terms of calculating this. Those stocks have delivered much higher returns than the stocks whose price lag, those stocks whose relative price performance ranks in the bottom 30%. And you look at large cap stocks, again, you see this huge difference where your winners in large cap momentum stocks, the ones that have whose relative price performance ranks in the top 30%, a 15.5% annualized return, versus the weak stocks, the weak momentum, those stocks whose price performance ranks in the bottom 30%, their annualized returns has been 6.9%. And so there's actually an acronym for momentum. It's basically WML, winners minus losers. By the winners of the stocks that are outperforming, the losers of the stocks that are underperforming. And we found over time this works really well. Then with momentum, what we find here, the stocks that are most likely to outperform are the stocks whose price performance ranks in the top 60%. So again, ranking the stocks from 0 to 100, the stocks whose price performance ranks in the top 4 quintiles, meaning they rank in the top 40% of relative performance, meaning their price returns over a certain period relative to the price performance of all other stocks over the same period, those winners tend to have the best performance. And we can use different periods. Momentum can be used over 13-week periods, 26-week periods, which is equivalent to about 6 months, or 52-week periods, which is equivalent to about 1 year. And the reason why we don't use 4-week periods is a lot of evidence suggests that over shorter periods, momentum can actually be mean reverting, meaning that stocks that outperform over a 4-week period have a tendency to go back towards the average, and stocks that underperform tend to come back to average. And if you think about earnings surprises, because we're in earnings seasons right now, it's not unusual to see a big reaction to a stock after it reports earnings. Shocks everybody with better than expected earnings, the stock price might jump, but then it might start leveling out after that big jump, maybe pull back a little bit. Or if a stock just completely misses analysts' expectations, completely disappoints its investors, stock price might drop, but then you might see it stabilize or come back a bit. So we do see over very short periods, this pendulum where it might swing one direction, it comes back a little bit. But when we start looking at what stocks have outperformed over 13-week periods, over 26-week periods, over 52-week periods, we tend to see that being more persistent. We tend to see that outperformance being a bit sticky. Now, the momentum strategies, momentum works, but at a stock level, an individual stock level, it's not quite as persistent as value is. So it doesn't mean the momentum is going to lead you to constant trading, but it doesn't hold for as long for a certain stock. A certain stock does not maintain its momentum factor as long as, say, as it holds its value stock, as its value factor does, as its value trait. So momentum strategies can have higher turnover, and therefore in an environment where you're considering transaction costs, and even though we don't have commissions, we still have differences between the bid-ask spread. If it's a smaller stock that's less actively traded, we might move the price of their trades, so it can have a little bit of additional costs to it. But what we do know, momentum works. And how we measure momentum here at AAII is we use a weighted 4-quarter approach. So let me explain it, because it's a little bit complicated if you're not familiar with it. We separate performance into 4 individual quarters, so 4 individual 13-week periods. As I said before, momentum works over 13-week periods and it works over 52-week periods. So this is a blend between the two. We weight each 13-week period separately. And so as you can see on my screen, the past 3 quarters are all assigned a 20% weighting. But the most recent quarter, the most recent approximate 13-week period, we're assigning that a 40% weight. So what we're doing is we're giving extra emphasis to the most recent performance, that performance over the most recent 13 weeks. But when you look at the total momentum score, it's about 60% weighted to past performance. So quarter 1, the most recent quarter, that gets a 40% weight, but then quarters 2, 3, 4 combined get a 60% weight. So we're still giving some past history. So perhaps the stock jumped a lot over the most recent quarter, but it tanked previously. The momentum score is going to adjust for it. And what we did, when we did some testing on it, we found this actually works better than a pure 52-week relative strength, or perhaps using a shorter relative strength measure. And again, what we're looking here for our value scores, we're looking for stocks that have outperformed have ranked in really the top half of outperformance, the top 40% of outperformance relative to all other stocks. In the chart you're seeing here, for those of you curious, this is for Quanta Services, one of the stocks we hold in the VMQ portfolio. This is basically an infrastructure type stock. They provide engineering and consulting services. And we're waiting to see how much they'll benefit from the infrastructure bill. They haven't come out yet and give us any guidance on that. But as you can see, over the past year, it's done really well. It ranks high on the momentum score. And so again, just talking about our weighted 4-quarter relative strength rank, just give you some data about how it works. And as I've said, it's worked better than many other momentum indicators. We did test it. We found this one works actually quite well. Now, momentum factor, it works really well historically, but like value, it can go through periods where it underperforms. Any factor. And if I was talking about size, we would see this. If I was talking about quality, it can crash. And so momentum, it can also underperform. So when it underperforms, it means momentum is just not associated with above market returns. Crashing means it stinks up the place. And where we see momentum factors tending to crash is when there's been a big shift in the market. And a prime example was the financial crisis. So as you all remember, heading into March 2009, most stocks were falling, but there were a few defensive stocks that were holding up really well. Once the bottom hit in March 2009, suddenly we saw financial stocks jumping, we saw real estate stocks jumping. A lot of the stocks that were being down the most heading into March 5th, 2009, suddenly did really well. And the stocks that were doing really well up until the market bottom suddenly underperformed by quite a lot. So when we say crash, it doesn't mean the stocks with strong momentum suddenly stop realizing positive returns, but their outperformance vanishes. And we see this when there's a big shift in the market. But because momentum considers recent performance, it does actually tends to roll over, and stocks with high momentum scores tend to see the scores drop. Stocks that previously ranked weaker momentum start to come in favor. So that's where that turnover comes into play. And again, we tend to see that particularly when there's a big shift in the market, a big rotation in the market in terms of investors previously favoring one sector, one type of stocks, and now suddenly they have a big shift to another types of stocks. What we tend to see under more normal market conditions is more of a gradual shift in momentum, where some stocks do really well momentum, or exposure to momentum factor fades, and other stocks take over. So we see more of a gradual shift. But when there is a hard shift in the market, then we can see this quote unquote crashing of the momentum factor. And the one thing that's interesting, so you're looking at this, you're probably thinking, okay, value, you're telling me to buy cheap, momentum, you're telling me to buy what's doing well. That seems paradoxical. But the reality is that value and momentum make great roommates. They pair really well together. And I think one of the reasons why is if you look at academic ratio, academic literature, they'll say because they're really not correlated. But I think the other reason why is there's a psychological reason at play. When you have a value stock that's doing well, it tells you that other investors are looking at that stock and saying, yeah, that stock is undervalued. It should be worth more. It's a sign of other investors recognizing that stock's a bargain. And what value investors try to do, they're not only looking for cheap stocks, but they're looking for stocks that are underpriced. Because again, some stocks are cheap for a reason. And when you apply momentum to valuation, you're basically taking advantage of what market efficiency exists. So efficient market theory holds that you don't gain anything by doing any market research, by doing any stock analysis, because all known information about stock is already priced into it. Now, some of you who are active investors are probably scratching your head or saying, well, no, that's not right, because I've managed to do better than the market. And the factors are anomalies, meaning the markets aren't fully efficient. And so what combining value momentum does, it doesn't throw out this idea that the markets price in information. It doesn't throw out this idea that the market's always right, but rather it says the market's partially right, and the market can give you some information. And if you know what to look for, you can use it to your advantage to identify stocks that might be more prone to rise in price. And that's why I think combining value and momentum works together. Momentum tells you other investors are recognizing there's something about the stock that suggests it's undervalued. And value's telling you the stock's cheap relative to all other stocks. And then when we overlay quality, then we're saying not only is this stock cheap to other stocks, not only are other people recognizing the stock's a bargain, but this is a really sound company. This company arguably should be worth more because it's a fundamentally sound company. And the other thing about combining value with momentum is it actually boosts returns. So this is data from S&P 500. This is their factor scorecard. And I mentioned earlier about the S&P 500 having subset indexes. This is it. S&P Dow Jones indexes tracks different indexes for the S&P 500. They track the main S&P 500, which you see there in red, but then they have a bunch of subset indexes. And so each of these indexes you see on the screen here are small subsets of the S&P 500. So growth and value, those are probably your biggest ones. You basically take the S&P 500, split between the high and low valuation, and there's a little bit of overlap. Each one has about 300 stocks in it each, but basically they're splitting it down the middle. Here's our value portion, here's our growth portion. All the other indexes tend to be smaller. So you can see on there's dividend aristocrats, stocks that are raising their dividends. You have pure value, which are really your approximate 200 cheapest stocks in S&P 500. And then you see in the green square, momentum QVM top 90%. So this is basically looking for value stocks with strong momentum. They're looking for momentum and they're approximately ranking the top 90%, but are also value and also have the quality traits as well. And as you can see here, this has not only outperformed the value, it's not only outperformed the pure value sub-indexes, but it's also done so with less volatility. And as you can see, over the last 15 years, it's actually outperformed the S&P 500 as well with less volatility. So higher return, less volatility. Now, I will point out, had I shown this chart about a year ago, you would have seen this index underperforming the S&P 500 by a little bit. So it does go through periods of underperforming because value has lagged. But now we're starting to see value coming back. It's helping the performance of this. And for those of you who are interested in tracking this, I will point out, you could actually just type in S&P Dow Jones indexes factor dashboard into, say, Google or the search engine of your choice, and you can actually see the report. It's updated monthly, and they update this chart monthly, showing you the performance for different factors and different sub-indexes of the S&P 500. But I think it's useful to show you just how, when you combine value momentum, how it actually does lead to better performance. John, before I move into quality, are there any questions I can answer?
Yeah, I mean, we're running a little bit long, but I'll ask one quick question here. So why are financials and REIT stocks omitted from the VMQ model?
The simple reason is just because financial stocks have different balance sheets, different income statements, because the way they're financially structured, a lot of traditional measures such as price of book, price of sales really don't work well with financial stocks. So nothing wrong with them, but for financial stocks and also with real estate investment trusts, because of the way their statements are structured, and those traditional measures such as price of sales, price of book just do not apply well to financial stocks.
Thank you. Well, we'll defer the rest of the questions till the end of the presentation. Continue on, Charles.
Sure, absolutely. Absolutely. So as I said, we look for value, look for momentum, but if you just look for that, you find it in a lot of stocks. So one of the things we do is we try to actually narrow down a list by overlaying quality. And for quality, we're basically we're looking for companies that are fundamentally sound. And we apply 8 different measures for it. Return on assets, return on invested capital, gross profit to total assets, the buyback yield, the change in debt, accruals of total assets. So we're basically looking for companies that have a lot of their earnings are attributable to actually cash flow. They're actually recognizing cash as opposed to recording earnings as an accounting figure. The Z double prime bankruptcy risk score, this is basically a measure of whether or not the company's at risk of going into default. Simple measure, if the score is above approximately 3, the company's in safe zone. If it's below 1.8, it's in danger zone. And finally, F score. This was developed by Joseph Petrosky. It basically uses approximately 9 different factors to see whether or not the company's fundamentally sound. And we're basically looking for companies to score well in most of these factors. So looking for stocks, low valuation, strong momentum, but we also want to have them have strong underlying quality. And our process for calculating the quality scores, just like I showed you for value, we figure out how does the stock score on each one of these characteristics separately relative to all other stocks. So you can see here for Sally, its return on assets ranks in the 83rd percentile of all stocks, the top 80% for all stocks, its return on assets, the profit that's making based on its assets. And then we do that for every factor, combine it to create a composite rank, and then we compare that rank against all other stocks. And that gives us a relative rank. So what you can see here with Sally, and I apologize that Bob's slider chart will have to actually flip it. It looks like we got a little bit wrong when we did this, but Sally's quality score actually ranks in the top 98th percentile. So of all stocks, its quality score ranks in the top 98th percentile. So it says Sally is actually very strong relative to all other stocks. And Sally Beauty Supply, they're the beauty supply store. They make a lot of money off of hair color. They've actually done quite well during the pandemic, and they're having a turnaround. So we're actually seeing management turn the company around, and we're seeing that reflected in the company's quality grade. Now, for the quality score and grade, we just like value, we don't require the stock to have valid ratios for all 8, but we want it to at least have at least 4 of the 8 measures that have positive scores so we can create a quality score rank on it. And this is a 2-step process. First, again, we look at how each individual criteria ranks to the same criteria for all other stocks, and then we do a composite then we create a composite valuation score. And so, again, we're looking to compare how's the stock on a composite base compare to all other stocks, and that's how we create our quality score. Now, using value, using momentum, using quality is great, but we still want to apply a couple other things in it. So if you think of, you're an active investor, I want you to think about, are there some non-negotiable criteria? Are there certain things that no matter what you wouldn't want in a stock? Write those down. So for VMQ, we do have a couple other limiting criteria. We demand our companies being profitable. We don't want companies that are losing money. We want the price to be at least $4, preferably above $5, so we're not worried about the stock being delisted. We do require all stocks to be exchange listed and being current with SEC documents. I avoid Chinese stocks because there is some questions about their accounting, and there have been questions raised in the past. Russian, there aren't many Russian listed stocks right here, but again, I just don't trust Putin on this. We do tend to avoid foreign stocks because their accounting methodologies might be a little bit different. There might be differences in how their financial statements are structured. For that reason, we avoid them. Nothing wrong with ADRs or ADSs. Just again, it's just because of potential differences in their accounting statements. And it's the same thing with financial stocks and REITs. As I said earlier, valuation measures like price of sales, price to book, right? Even when we go to our quality measures, some of our quality measures don't apply well to financial stocks. So we weed those out. So there's a lot here. How do we put this all together? Well, what we look for is we look for stocks that are ranking really well in all three indicators. So we have two things. We have scores and grades. So grades are basically all the scores broken into quintiles. So easy way to think about this, an easy way to understand the VMQ strategy is it's just like in school. You want A's or B's. A's or B's will make your parents happy, particularly A's. D's and F's will get you grounded. So to qualify for the VMQ portfolio, stock needs to have a value grade of A or B, meaning its evaluation ranks in the cheapest 20 or 40%. Its momentum, its relative price performance ranks in the top 80% or 60%. So an A or B. So for valuation, lower scores are better because it signifies a cheaper stock. For momentum, higher scores are better because it signals stronger momentum. And then we also want strong quality. So again, looking for that grade of A or B. Now our sell rules are very simple. If any of the three grades falls to an F, we will get rid of the stock. If also the company stops being profitable on a 12-month basis, then we will sell the stock. Otherwise, we'll only sell stock if certain things happen. For instance, we've had about 6 or so companies in the portfolio since we've launched the portfolio been acquired. So something like that, we will sell the stock. But by and large, our goal is to hold on to stocks and to limit turnover as much as is reasonably possible. And so you can find all this on our VMQ Stocks website here. Every week I provide updated commentary about what's going on in the portfolio, trends I'm noticing. But you'll also notice here at the bottom where you see value grade. You'll see a couple arrows. We tell you when a grade changes. When a grade rises, it gets a green arrow. When a grade worsens, it gets a red arrow. So you can easily look at our site and see which stocks have rising grades and which stocks have negative grades. Here's our portfolio. We have a portfolio of 20 stocks. This is a real life portfolio. We actually run it through a brokerage account. And as I said before, we hold stocks of all different criteria, of all different market cap sizes, as far large as Target to small caps such as USA Truck. This gives you a sample of some of the stocks that we have in here, and we will show you the value grades and the scores for all stocks. Now, if you look real quickly on the right-hand side where it says portfolio notes, and you'll see where it says qualifying, that tells you a stock's currently in the portfolio and it currently meets our buy rules. So if you're looking at the portfolio and you're wondering which stocks to consider first, the qualifying measure can be something you can use. As far as the type of stocks we hold in the portfolio, real quick, so about 40% of our stocks that we've held in the portfolio since we accepted VMQ, we started VMQ at the beginning of 2018, about 40% have either been large cap or mid cap, and about another 40% have been the S&P 500 small cap. So about 20% stocks have been too small to even be in the S&P small cap 600. We are market cap agnostic. I will go up and down the market cap scale. As long as the stock scores really well in value, quality, momentum, we will generally consider it. We're not worried about market cap. But the other thing, for those of you who are dividend investors, I'll point out, although we do not require dividends to be paid to qualify for the VMQ portfolio, I will say about half of our holdings have paid a dividend. Now, if you're looking for just more ideas beyond our portfolio, we do have our VMQ ideas list. This shows you all the stocks that are currently meeting the VMQ criteria. It's what we use to find ideas for the VMQ portfolio. So if you like the methodology, but you want to apply it yourself versus following our portfolio, we do give you that option. We actually let you see what we're actually looking at for potential new candidates. And again, our process for selecting candidates, I talked about this earlier. I basically look for stocks with the lowest value score and the highest momentum score. So cheapest valuation, strongest momentum. And then I always just do a little bit of due diligence. And I think it's important whenever you're using a strategy for identifying stocks, just do some research. Go to SEC Edgar's website, look at the 10K, look for any red flags that might pop up. We at AAII try to avoid stocks with dual class ownership. If I go through the news and I see perhaps mergers occurring, because screens and cross filters tend to be quantitative, they can't identify everything. Obviously, the stock's about to be bought out. I don't want to purchase it. If there's been something else just not identified by the screen, if there's just something that seems odd that makes you queasy, that would be a reason to avoid buying the stock. But as much as possible, I trust the strategy. I follow the model. And so I let the model tell me what to look at and what to consider. And it's only when it's a really big red flag will I pass on a stock. And if I do pass on a stock, in the commentary, I will point out that I did look at the stock and we passed on it for X reason. So let me give you a few final stops before we finish up, and I'll take some questions. One of the things I want to point out, again, just reiterate this. If you want to beat the market, you need a portfolio that's going to look different than the market. And that's what VMQ is designed to do. We're not trying to be like the market. We're trying to get returns that are different than the market because that's how we beat the market. And being truly active is going to lead you to a different portfolio. So even if you're focusing, as someone asked earlier about S&P 500 holding a small subset, you still want to have a portfolio that's at least tilted. You do not want to have the same return characteristics of the S&P 500 because then you'll get the same return of the S&P 500, in which instance you should just buy an index fund. But if you want to have outperformance, look about how you can outperform. And I'm a big believer that using factors such as value, quality, momentum can help you get that outperformance. And realize that when you combine factors, it's not always easy for people to do. People always go to factors, and because people are always going to it, it actually creates a feature because not everyone's willing to do it. That gives you the excess premium. Going on the path less followed is often very profitable for investing because you don't get this crowding out. The premium stays because there's not enough people to arbitrage that premium away until it lasts and it continues and it goes on, which gives you the chance to take advantage of it and helps boost your returns. So John, are there any questions?
Yeah, in fact, Charles, why don't you bring up that next slide? Because I think there's
sure.
a graphic in there. I noticed one of the things you didn't really talk about as far as features and capability is the notion that there is a VMQ analyzer that exists within the service. And I see a little slide there for cons. So basically, you could put a ticker symbol for any stock that's publicly traded in the US, and you'll get back a report with the grades as far as value, momentum, and quality. And that'll help basically tell you which stocks to buy when. Is one of our old marketing guys used to like to talk about as well, I think. So any other features that you haven't perhaps discussed? I know Neil is asking in terms of if you're a subscriber, how often do you issue any kind of reports, any kind of notices? What kind of benefits do you get as a subscriber? And how often does the turnover occur?
Yeah, no, that's a great question. So one of the things I'll point out here, and I will point out real quick, I have the slide on here. We are offering right now real quick a special on VMQ where you can try it for 6 months for $99, or if you want to try all our newsletters, VMQ, DI, our A+ investing service, and SSR, you can get all of them for $99 for 6 months. But I want to, if you look, I'm going to go back here for a second, show you the screen. So let me get the other way here. If you look at our VMQ ideas thing, you'll see the little plus marks by each of the tickers. What those plus marks are, and you'll see this across AAII website. What they are, it gives you the ability to actually add stocks to your portfolio. So we have our My Portfolio portfolio tracking tool at AAII.com. My Portfolio allows you to track your own stocks. And one of the advantages about being a VMQ subscriber or a Platinum subscriber is once you're in My Portfolio, we have a drop-down tab that says VMQ, basically says VMQ on it. And what it allows you to do is actually see the VMQ grades for your own stocks. So as a Platinum or VMQ Stocks subscriber, you can actually see the VMQ grades for your own stocks. You have that. We also, as VMQ subscriber, you can get grade alerts. So if one of the grades for your stocks changes, you can be notified via email. Now, as far as turnover, over the last year, our turnover has been about 30%. The last time we changed the stock, I want to say, I'm off memory, I think it might have been September or October. We do try to limit turnover. Depending on how volatile market conditions are, that will impact it. But one of the things we do at VMQ, I talked about momentum grade. We tend to use a 1 week probationary period. So if a stock's momentum grade or its value grade or its quality grade falls to F on a Friday, because when I send out my commentary each week, I send out commentary on Friday. So if the one grade falls to F on a Friday, we'll give the stock 1 week to see if it recovers or not, because stocks can be volatile, they can move, and so we don't want to have excess of trading. So we do try to limit the number of transactions. But one of the benefits, as I mentioned, you also get the commentary. So each week I provide commentary, what I'm saying going on the market. I provide a lot of research about the factors. If I see new research about the value factor, the quality factor, the momentum factor, I'll share it with you. But I'll also talk about the portfolio and cover all the stocks in the portfolio and explain what's going on. If something special happens with one of them, we'll point that out as well. So we do try to keep investors informed. But I also periodically go through the VMQ strategy, give people a refresher. Here's what we're doing, just to make sure everybody understands what's going on in the strategy. They understand how to use it, because ultimately our job here at AAII is really to empower you, the individual investor, to make really good decisions and to be an effective manager of your own assets.
And Bill here actually has 2 questions, and they're sort of related. First of all, when it comes to weights, if you're putting together a portfolio, do you recommend, how do you recommend how many shares to buy, how much to invest in an individual position?
Yeah, absolutely. So for our portfolio holds 20 stocks. We suggest to investors wanting to follow VMQ, we suggest they hold at least 10 stocks to get diversification. And you want to hold enough stocks because any single stock can do really well or really just do terribly, to be honest. So you want to get a diversification, because if you hold too few stocks, you start encountering too much idiosyncratic risk, which means risk associated with a specific stock, or if you're buying bonds, a specific bond. So you want to get that diversification. We suggest equal weighting. So allocate the same amount to each stock. So to give a very simple equal dollar amount, exactly. So say if you're going to allocate $10,000, you put $1,000 to each stock. Now, what we do with our portfolios at AAII is then whenever we add a new stock, so once you have a portfolio, it starts changing, and you're not going to have $1,000 to allocate to each stock. Over time, each stock's going to perform differently, and your allocation is going to change. So in the future, every time we add a new stock, we look at what is the value of the portfolio right now, average it by the number of positions. For VMQ, it's a VMQ's portfolio value, which right now is approximately, I'm going to say, about $140,000. Divide that by 20, which gives you about $7,000. So were we going to add a new stock right now, our target, what we'd look to add, is about $7,000, because that would equal the average position in each stock. But we're big believers in trying to equal weight at the start, and then try to always invest an equal dollar amount, a dollar amount equal to the average position size of your portfolio going forward.
And I guess as a follow-up question, I think the answer is no. But so if a person doesn't want to follow this and build their own portfolio, there's no fund out there they could invest in instead.
There really isn't. Probably the closest is I showed this that strategy earlier, the S&P 500, the top 9% QVM. Invesco has an ETF that tracks that index. That's probably as close as you're going to get. But even then, that's limited to just stocks in the S&P 500. There really isn't. And even if you try to build your own portfolio, you say using separate value, momentum, and quality ETFs, you're still not going to get down to that smaller size. It's actually very difficult to do it with ETFs. You can get the general strategy of value, quality, momentum, but the one nice thing about VMQ is the academic research actually includes small size stocks. And with VMQ, we actually do consider the small size stocks, whereas a lot of ETFs just can't do it because they have too many dollars to invest.
And I've got two questions here from one from Mark and one from Carlo. So VMQ has value, momentum, and quality, and they must be A+ subscribers, or they're familiar with A+. A+ investor has two additional grades, a grade on growth and a grade on earnings estimate revisions. Is any thoughts as to how that would make this different from that service, or why in particular you didn't choose to include those factors in this VMQ process?
Yeah, absolutely. So the more you add in terms of stock selection, the more you add in terms of a stock selection strategy, the more more restrictive it's going to be. John mentioned earlier in my book, Better Good Than Lucky. When I did that, when I actually created that strategy, I had a low valuation growth strategy to it. And what I found with it, part of the reason I ended up with VMQ is my strategy I found to be too constrictive. So the more you acquire in terms of stock, in terms of performance, the more restrictive your strategy is going to get. And at some point, you might actually have a strategy that's so restrictive, you're not finding enough stocks to actually create a diversified portfolio. So that's one consideration. The other thing is we found that really value, quality, and momentum are, in terms of performance, in terms of factor performance, those three have been shown to actually be three of the strongest factors in terms of performance. Now, not to say I'm anti-growth. I think growth is great. I just don't think you should overpay for it. Now, if you're a big believer in growth, but you like the idea of having the value, momentum, and quality traits, you could do that. You could actually use our grade screen or an A+ to actually build a screen to do it. But I found a more focused strategy works better in terms of both building a diversified portfolio, but also in terms of performance. So nothing wrong with earnings. I love earnings estimate revisions. I love growth, but I chose to actually use a more focused strategy. And I will say VMQ actually predated A+. We did develop the growth score afterwards. We developed the earnings estimate score afterwards as well. But again, I think if you add too much into the mix, you're going to get a strategy that's just too restrictive. It might prevent you from actually building a diversified portfolio.
And if you wouldn't mind switching back to slide 33.
Sure.
And can you just go a little greater depth? I have a question here for people just to understand how the sell rules work in greater fashion. So you actually you buy them when they're when they're like A, but you kind of will let them move along the spectrum until you sell. So you just get a little bit of time talking about that.
Yeah, absolutely. So when you look at the performance of different factor strategies, you tend to see, I guess, skewing in returns, to use a word. So if you think of a barbell, at one end you get the weights on both ends and a long bar in the middle. So at the top end, you have the stocks that do really well in a given factor, that score really strongly in a given factor. You tend to see a lot of outperformance, particularly the top 20%, top 30%. And then if you go to the other end, the stocks that tend to have the worst performance tend to be at the bottom 30, 20% of a given factor. Now, in between, you have a lot of stocks that maybe perform a little bit better than the markets, are pretty close to the market. So you get this market performance. And so, the one strategy is the thought, well, I'll just buy all the stocks with the strongest grades, the stocks that are doing really well, and I'll just keep, and I'll get rid of them when they fall, say from A to B to C. Well, there's two problems with that. A, you'll get a lot of turnover, but B, sometimes the stock will have done really well in one of the grades. When we bought it, it will fall, but it will keep outperforming. And so we've seen this with Target. We've held Targets really since it incepted the portfolio. Its returns are up over 200% since we've added it. But Target doesn't actually qualify when you look at the score. It doesn't have A's and B's across the board, but it's still grown. So we want our winners, or give our winners a chance to run. So we don't want to pull the sell rules too quickly. We don't want to pull the carpet underneath the stocks too quickly. We want these stocks to have room to grow. And so our reasoning is, let these stocks have time to grow. Let these stocks have time to fluctuate. Let these stocks realize higher returns, and only really get rid of them when they really have traits that suggest they're going to underperform. So it's really a combination of limiting turnover, but also letting these stocks have room to appreciate even further versus just trying to constantly turn over the portfolio.
And just as a further clarification on that, so when you're buying a stock, you're looking for that intersection of value, momentum, and quality. When it comes to selling, any one of those factors can trigger a sell. So you don't wait for all three of them to go to F's. Any one of those factors, if all of a sudden the valuation, stock price goes up and the valuation's out of whack and it's an F now, you will sell it for valuation, or you'll sell it because the price momentum has gotten to be F and stayed there for a while, or the quality is deteriorated. So any one of those will be a factor to sell, but all three have to be a factor to buy. Did I summarize that correctly?
Absolutely.
And when it comes to any other considerations for selling, so the gentleman was asking here if do you recommend trailing stop losses or things like any kind of mechanical measure such as that to help protect your profits?
We don't use them. There's some debate about them. I know some people really like having them, and I would say psychologically, if it helps you sleep at night, that use trailing stops, go ahead and use them. I don't. I have the momentum. I know the momentum score is going to provide that backdrop, or say that backstop, in terms of the stock underperforms too much. In the past, I have used them. I don't use them now, but what I would say is if it helps you sleep at night, use them. But I would also suggest to you that you set up price alerts, or know where that 30% line is. And if that stock violates that, then stop and take a look. Is the whole market down? Does it seem like something's a little bit irrational with the stock, or is it purely a reason for selling it? And the reason why I say this, if you go back to say the flash crash back in 2000, I guess 11, where stocks suddenly dropped and they bounced back, you don't want to necessarily have a stop loss execute on a day the market's just really volatile. You want to make sure that you have a moment to at least see what's going on and make sure that, yes, I really do want to sell the stock.
And a question here: are you familiar with a product called ZAC VMQ? And if so, how do we compare?
I am not familiar with it. I used to work at Zacks. I cannot tell you about that product though.
Okay. And then we'll kind of close up on this one question here. Would you consider VMQ to be a growth or income focused approach?
It's definitely a focus on capital appreciation. Really focus on capital appreciation. Although, as I said, about half our stocks have paid dividends. That's a side benefit. I would say if they're really interested in dividend stocks, our dividend investing portfolio looks for stocks with rising dividends. And as I said here, we have an offer right now where we're giving you 6 months of platinum. And the nice thing is, if you want to take advantage of this trial, you get VMQ and you get DI plus SSR plus A plus. So it gives you a chance to actually look at both DI and VMQ and decide if both or if one's actually better for your purposes and one's more interest to you as well.
Well, thank you, Chuck. And obviously we know you as the professor, the man with the bow tie. So I guess the question is, when you do your next presentation, because I know you're doing the at Prism Wealth Building Academy stuff, we'll see if you're going to actually be wearing a bow tie for us next time. So with that, I guess we can't hear Jenna, so I think what she's telling us is that we have some webinars coming up. First of all, we have webinar will be available as a replay tomorrow, and we have another live show coming up, and it's finding your personal preferences, the right investment, and then Charles will be here, and it's part of the VMQ process. I'm guessing Jenna, who is also a moderator on our investment community, will be here to help pull in your questions. And what Charles has been doing is he's been going through the 5 steps that are really helpful to help you as an individual investor take control of your future, how to plan out your various goals in life, how to do a risk assessment, how to realize what kind of asset allocation is important for you. And then the next step in that is determining how much time and effort you want to spend in managing your portfolio. So if you want to be active and make your own portfolio, then you can go ahead and use something like VMQ. If you rather use ETFs or funds, I think you can do that as well. But the whole process of using your preferences, that'll be our topic of next week, Charles, I think, will be to actually kind of go through a worksheet that you've developed. And perhaps as homework even, I recommend you go to our online community, take a look at all the various worksheets that are available for you to download, and take a look at that I worksheet. And it'll help give you some sense for what you might want to go ahead and anticipate in our webinar next week. And also we have an individual investor show coming up and that'll be on February 23rd. And you're going to be interviewing perhaps someone there. I'm sorry, I don't see on the slide. My apologies there. But please go ahead and go to our website, click on community, and if you see there, you'll see an area to log on and sign up for future webinars and shows. So thank you very much. I think we have a little slide presentation from a sponsor here, Discover, coming up. And Charles, great presentation. Thank you so much for being here, and thank you for all the work you do. You really do a great job of, I think, bringing a strong educational research basis to the individual investor and highlighting the kind of strengths that they have as an individual and how they can succeed and how they can control their destiny, because no one takes more control of your destiny than you do as an individual investor. So thank you, Charles. Great presentation.
Thank you, John. Appreciate it. If everybody watching shows up next week, I promise I'll wear the bow tie.
Sounds good.
And now for a message from our friends at Discover Bank. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner Discover Bank on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Take a look. With Discover, you can earn over 5 times more interest than the national savings average with preferred member rates and pay no fees. That's no fees, period. Plus, no minimum balance is required. You can access your AAII member savings account with Discover Bank from your smartphone or tablet, so it's easy to keep your money moving in the right direction. Open an AAII online savings account to start saving for the future today. Visit AAII.discoverbank.com to learn more.